My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to introduce accounting for pensions. Accounting for pensions is one of the more complex financial and accounting reporting topics that we discuss. And so I'm going to break this video into several different parts. And in this particular video, all I want to do is introduce essentially the concept of pension plans. So pension plans are arrangements, financial arrangements, whereby an employer provides benefits to employees after they retire. The reason why firms do this, of course, is to attract highly qualified employees and use that as a mechanism also to retain existing employees. And the nature of a pension plan is that there are a lot of complicated or potentially complicated actuarial considerations that are involved in estimating the liabilities as well as the expenses associated with pension plans. There are a couple of important definitions that we need to make sure that you understand as they relate to pension plans. And some of this can be a little bit confusing. There can be what are known as contributory or non-contributory pension plans. A contributory plan means that the employees bear part of the cost of the benefits and make payments to the plan in order to increase their benefits. That is true whether we are talking about a defined contribution plan or a defined benefit plan. So contributory and non-contributory, those two words have to do with whether the employee is expected to make any contributions to fund their own retirement. Contributory plans, employees are making at least partial contributions to fund their retirement. Non-contributory plans occur when the employer is making all of the contributions, bearing the entire cost of the plan. Most of us are going to be in what are known as contributory plans. Most of the time, employers are going to expect the employee to make at least some partial payment, some contribution to their own retirement. Non-contributory plans exist primarily for high-level management within an organization, probably limited to the CEO, maybe the CFO, and a couple of the other chief officers of an entity. But by and large, non-contributory plans are going to be limited to a very small group of employees at the very top of the organizational chart. Most important for you to understand is that there are two types of pension plans. There are what are known as defined contribution plans and defined benefit plans. Again, most firms, particularly new firms, are implementing only defined contribution plans. A defined contribution plan simply means that the employer defines by formula their contribution as well as potentially the employee's contribution to the plan. The formula might consider factors like age, length of service, employer's profits and compensation level, and so on. A lot of times it is just simply based as a percent of the employee's salary. And so a defined contribution plan, the employer might say, we will contribute up to 3% or up to 4% or up to 5% of an employee's wages and salaries to that plan. If the plan is contributory, then the employee is also going to be making payments or contributions to the plan. And those combination of payments, employer contributions as well as employee contributions, will be pooled together into an investment fund held by an independent fiduciary entity and be managed by that entity. These plans are sometimes called 401k plans. That technically doesn't have anything to do with U.S. GAAP. 401k is a reference to the IRS tax code that prescribes the tax deductibility requirements for employers making contributions to these types of plans. The second type of plan is what's known as a defined benefit plan. In a defined benefit plan, employees will receive at the time of retirement a defined amount or a defined set of benefits. So the difference between a defined contribution plan and a defined benefit plan. Defined contribution plan, it's the current contributions to the plan that are defined by a formula. In a defined benefit plan, it is the employee's retirement benefits that are defined by a formula. And typically, what happens with a defined benefit plan, it's very common to see something like, we will pay 2% of your salary multiplied by the number of years of service that you've provided as a retirement benefit. So when you retire, let's say you've worked for an entity or an organization for 20 years, and their formula is 2% times the number of years of service multiplied by your last year's salary. So we determine what your salary is the year that you retire or the year before that you retire. We multiply that by 2%, and then we multiply that by 20 years, or whatever number of years of service you've provided. So you would end up then with a retirement benefit in that case. Let's say that when you retire, your salary is $100,000 a year, and the formula is 2% times number of years of service, and you've retired after 20 years of service. So you would get 40%, 2% times 20 years would be 40% of your last year's salary, which would be $40,000 a year in benefits. Notice here, there's no mention about how we are funding or providing cash to fund this benefit. What's defined is the end benefit, what you get once you retire. And so a defined benefit plan is really the complex form of a pension plan, because that's where a lot of the actuarial estimates come into play. We have to estimate how long do we expect employees to work for us? What do we think their future salaries will be 15, 20 years from now when they retire? We also have to have some actuarial information about mortality, because most defined benefit plans, it is a retirement benefit that you receive for life, and there may even be survivor benefits for a spouse. And so we have to include that information in the estimates. It gets to be an extraordinarily complex process, and in fact there is a whole science devoted to just that, and that's the actuarial sciences. Actuaries do other kinds of estimates as well, but certainly one of their primary fields is going to be providing estimates with regard to defined benefit plans. So those are the two most common types of pension plans. Defined contribution plan, where the upfront funding is defined by a formula, and a defined benefit plan, where the benefits at the point of retirement are defined by a formula. Again, most firms now are implementing defined contribution plans. We still have to deal with, however, defined benefit plans, because they do exist, and even though a lot of firms are no longer starting them or no longer accepting new employees into those plans, there are a lot of employees at a lot of companies that are still under a defined benefit plan, and so we do need to understand the accounting for those. But those are the two major types of plans, and a little bit of the terminology that you need to be familiar with.